I look at the policy rates, they're about the same, 5.25%, 5.5%. Then I compare wage growth. So Atlanta Fed tracker for wage growth in the US is at 5%. I go to England, it's at 6%. Service inflation, services in England is at 6%. So we're looking at, I think, greater inflation pressures in England than in the US, even though the policy rates are the same. And I was just talking to our European economists, and he's also worried about impending further inflation on the goods side for England. Because, it's an importing country, and the Red Sea is shut down in terms of a shipping lane.
Yep.
So costs for shipping are increasing. So, I don't know. Everyone's bringing rates down. I'm worried about inflation. We're worried about upside risks to inflation.
And so if inflation stays hot, the Fed, in theory, drags their feet. We see cuts either extend out longer. Where are you putting money to work if that plays out and that is the case? Because right now I'm looking at NASDAQ 100 mini futures are up almost 1% today.
Yeah, let me give you 3 trades if you want to think about upside risk and inflation. Mm-hmm. Number 1 in bonds, go short duration. We're short duration, we have a cash overweight and a credit overweight.
Really? Okay.
It's not a massive position for us, but we're short duration. Number 2, in stocks, you have value versus growth. In the value universe, you have energy stocks that are sensitive to inflation, and I think that overall value is poised to outperform growth, especially because growth has rallied so much, if we get upside surprises in inflation going forward. And I'm not talking about going back to 9% that we had. I'm just talking about inflation above expectations, the consensus that it's really coming down smoothly, which is not. And the third trade we have in our portfolios is real asset equities. That's a diversified portfolio of stocks, including energy stocks, metals and mining, metals, and REITs. Really? So you get a position there that gives you, over time, some equity exposure as opposed to just going into tips. And that responds to inflation in a kind of like 4-5x response to the surprise, whereas tips would be more 1-to-1. So it's a higher octane kind of inflation hedge.
Looking at the U.S. market, NVIDIA's up another 2% today. It's up 82% year to date. Supermicro's up 215%. Meta's up 43%. 2 questions. One, what are you doing with this whole momentum trade, and how much further can we extend? And secondly, I look at the Micron earnings. They're going to have their best day in 13 years, and they're up 18% on AI growth. So, can they keep going further with the fact that sales are smashing expectations?
Look, I love that question because I'm working on this with the research team this week. I'm writing a note for our internal research platform with a cute title that is, do you have FOMO on the Momo because of YOLO?
That's got it all, right?
I thought about this for you. I know it's going to be on the show. You're in the media game. You want talking points. Here's the counterintuitive conclusion that we're finding. Momentum is working better than it's ever worked. I have data going back to early 1990s, even data going back further. It's never worked that well. If you look back 12, 16 months, here's a dumb strategy, okay? You could just rank the stocks in the S&P 500 by trailing 12-month returns, pick the top 10, hold them for a month, repeat. Okay, if markets are efficient, finance professors will tell you this should not work. Well, in history, it's never worked that well, so maybe not so dumb a strategy. Now, when do we get worried about momentum? And that's why our conclusions are counterintuitive. We're not that worried about it, even though it's extreme. Because it wasn't extreme before the last 3 bear markets. When momentum is in its top quintile, the forward return for stocks is an average of 14%. Yep. Now there's a big caveat there, which is there's a fat tail, which is 2000, when we had the mother of all momentum crashes. But the difference between that momentum crash and the situation we're in right now is that the situation we're in right now, momentum stocks are supported by fundamentals. There's huge momentum in fundamentals. So quality and momentum are moving together. They're both performing well. If you do an autopsy of the 2000 bubble, it was junk stocks, non-earners with momentum.